passive investing was supposed to be the greatest financial innovation of the last 50 years. Low fees, instant diversification. Set it and forget it. The triumph of common sense over Wall Street's overpriced stock pickers in Patagonia vests. And for the most part, that pitch is true. But there's a part of the pitch nobody mentions. And it's the part that's quietly turning your retirement account into a weapon being used against you. Because here's what the ETF industry doesn't put in the brochure. When you buy a passive index fund, you don't just own a slice of the market. You become a guaranteed, automatic, price-insensitive buyer of whatever gets added to that index. No warning, no opt-out. The mechanism that makes passive investing convenient for you is the exact same mechanism that makes you the most exploitable buyer in financial history, and right now, somebody is exploiting it. But to understand how we got here, you need to rewind about 50 years, because passive investing didn't always exist. For most of market history, if you wanted to invest, you hired an active manager, someone who picked stocks, charged you 1 to 2% annually, and almost always underperformed the market anyway. It was expensive, it was inefficient, and it was the only option most people had. Then in 1976, John Bogle launched the first index fund at Vanguard. The idea was radical and almost embarrassingly simple. Instead of trying to beat the market, just own the market. Buy every stock in the index, hold them all, and charge almost nothing. Wall Street laughed at him. They called it Bogle's folly. Then the data came in. Over a 20-year period, roughly 90% of actively managed funds underperformed their benchmark index. After FEs, not occasionally, consistently, decade after decade. And once investors understood that, the money started moving. Slowly at first, then all at once. Today, passive funds manage over $15 trillion in assets in the United States alone. More than half of all US equity fund assets are now passive, and the three largest asset managers on Earth, BlackRock, Vanguard, and State Street, collectively own meaningful stakes in almost every major public company in America. That's not a conspiracy theory. That's just what happens when the same three institutions become the dominant shareholder of basically everything simultaneously. But here's where the story gets interesting. Passive investing has a structural feature that almost nobody talks about when they're selling you on it. Index funds are rules-based. They don't think, they don't analyze. They follow a rulebook, and that rulebook says when a stock gets added to the index, we buy it. When a stock gets removed, we sell it. The price doesn't matter. The valuation doesn't matter. The fundamentals don't matter. If the rulebook says buy, every fund tracking that index buys automatically, and the people who write that rulebook, the index providers, S&P, NASDAQ, MSCI, they've quietly become some of the most powerful actors in global finance, because whoever controls the index controls the automatic demand. Let me show you exactly how this works. When a company gets added to the S&P 500, it's not just a badge of honor. It's a capital event, because hundreds of funds tracking the S&P 500 are legally required to hold that stock, and since they all have to buy at roughly the same time, the demand is immediate, concentrated, and completely price insensitive. Studies show that stocks added to the S&P 500 see an average price jump of 3 to 5% just from the announcement, not because the business changed, not because earnings improved, because the index rulebook updated. And here's what Michael Burry, the man who predicted the 2008 housing crisis, had to say about exactly this. Dynamic, passive investing has removed price discovery from the equity markets. The stocks included in indices are often not priced based on fundamental value. Like most bubbles, the longer it goes on, the worse the crash will be. Now, Burry has been early on this before, but the structural point he's making is real. When the majority of buyers are passive and price insensitive, the price signals that markets are supposed to generate start to break down, because price discovery requires someone to actually ask the question, is this worth buying at this price? And passive funds, by design, never ask that question. But this isn't just a theoretical market structure problem, because the real consequence is what it means for you. Specifically, here's how it actually plays out. A company prepares for an IPO. It lists on a major exchange. It engineers its listing to qualify for index inclusion as fast as possible. Once it's in the index, every fund tracking that index buys automatically. The stock price rises not because of earnings, not because of growth, but because of forced mechanical demand, and the original insiders, who bought in at a fraction of the IPO price, now have an exit. They sell to the passive funds, who sell to you, who hold it in your 401,000 without ever being asked. Buyers are forced in early. The sellers are unlocked later. Shares move from insiders sitting on a low-cost basis to passive funds and, ultimately, to retail investors whose retirement accounts absorb them at peak valuation. Your index fund is the exit liquidity, and the deeper problem is that this feedback loop is self-reinforcing. The more money flows into passive funds, the more price-insensitive demand exists for index constituents, the more valuable index inclusion becomes. The more companies engineer their listings specifically to capture that demand, and the more companies engineer for index inclusion, the more the index itself becomes a tool for capital extraction rather than a reflection of market value. This is the ETF illusion. The product sold to you as a passive, low-cost, market-tracking investment has quietly become one of the most powerful mechanisms for transferring wealth from retail investors to insiders, and it works precisely because it's invisible. Because you never see the transaction. You just see your total portfolio value and assume the market is doing its thing. But here's the part that should concern you most. Because the concentration problem isn't just about individual stocks getting pumped on index inclusion. It's about what happens to the entire market. When this much capital is managed this passively, when passive funds dominate, correlation increases because if everyone owns the same stocks in the same weights and everyone sells in a downturn at the same time, you don't get orderly price discovery. You get synchronized liquidation. Every fund tracking the same index hits the same sell trigger simultaneously, and that's how you get flash crashes, liquidity gaps, and market moves that have no relationship to economic fundamentals. It's the financial equivalent of everyone in a building deciding to use the elevator at exactly the same time, and the index providers sitting at the center of this system, they're not regulated like exchanges. They're not regulated like asset managers. They operate in a regulatory gray zone that gives them enormous market power with almost no public accountability. The entity that decides what goes into the index that your retirement account tracks is a private company with no public oversight and no fiduciary obligation to you. So what do you actually do with this information? The honest answer is there's no clean solution. Pulling out of index funds entirely means taking on the active management problem, paying more in fees for a manager who will almost certainly underperform. Anyway, passive investing, despite its flaws, is still probably the right answer for most people over long time horizons. But the right answer and the complete picture aren't the same thing, because the pitch you were sold is true. It's just not the whole truth. The whole truth is that the system built around passive investing has created structural vulnerabilities in markets that didn't exist before. That index providers have accumulated extraordinary power with almost no accountability that companies have learned to engineer themselves specifically to exploit passive fund mechanics, and that your retirement account, because of the very features that make it convenient, has become the most predictable buyer in the market. And there's a reason traditional financial media won't frame it this way, because passive investing is the product everyone sold you. The fund companies profit from it. The index providers profit from it. The banks profit from it. Beat 93. And a story that says the system might have some problems doesn't sell ads the way a story about which stock is going to double next quarter does. So nobody tells you. And you keep buying. And the machine keeps running. Because the feature that makes passive investing work for you is the same feature that makes you a guaranteed buyer for anyone clever enough to squeeze their way into the index. And right now, somebody is getting very good at squeezing. If you want to understand the parts of finance that actually affect your money, hit subscribe. Because the risks that matter most are never the loud ones. They're always the ones hiding inside the products being sold to you as safe.